countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Closing out a big week for big tech. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bosse.
And I'm Alexiou. Happy Friday, I guess, for the markets.
It's a good Friday. Well, it's maybe not a good Friday, but it certainly was a good week.
Yeah, it was a very good week. We're also well off the lows of the session. We're kicking off to the closing bell here in the U.S. This is where we stand. The S&P is now only down 0.1%. We were down as much as 0.6. We got the UMich consumer confidence data coming in at a 7-month low. Real lack of confidence in the economy due to inflation and higher rates. In the market, though, it is still quite interesting. Yes, tech is outperforming, but on the downside, you have industrials, worst performing sector in the S&P. We'll get to that in just a moment. Those early cycle plays still not doing well. And the S&P Hotel Index, you have Carnival, you have Norwegian Cruise, worst performing stocks on the S&P, as you had Bank of America saying the pricing right now is not as good as it was in the end of May. Where are you going, Romaine? We're going then to tech and the bond market. The 10-year yield's down 3 basis points. But over the week, Romaine, talking about a week, we've seen a move of 22 basis points down with the 10-year. So very strong into that safe haven bid.
All right, 59 minutes until those closing bells. And despite some of the red that you saw on Alex's screen today, this week was a big one for big tech. And while NVIDIA continues to be the lead dog in that space, Apple managing to reassert itself with its first record highs of the year, a 7+% gain this week alone, being added to the 17% gain from the prior 6 weeks.
Apple has kind of regained its seat on the throne here, next to the top players. And I think the story there is, pick up in China and then also some talks of the AI integration and things like this. They're finally on the map with that.
And it's fitting for Apple to finally join this broad market party because the cool kids at this party this year have mainly been in big tech. That includes the new kids on the block like NVIDIA, but also the old tech names out there like a Broadcom, like a Oracle, like an Adobe. On a weekly basis, the S&P tech sector outperforming the S&P as a whole by the most since 2002. Yeah, you heard me right. But as tech closes out a monster week, industrial stocks having a bit of a week to forget here. Industrial's the worst performing sector today. This after MSC Industrial. It's a supplier of metals and maintenance products. They said their original equipment manufacturing customers are sitting on way too much inventory and are now scaling back new production. And that's how we're looking to close out this week, Alex, with a tinge of anxiety around the manufacturing economy, but a tinge of optimism around AI and our technological future.
Yep, and those ISM manufacturing numbers really reflected in MSC. All right, let's get a look here on Apple's catch-up. It's just a fun chart. It's not normalized, so keep that in mind. The white line is Apple. The orange line is a Magnificent 7. And you can obviously see the underperformance of Apple here throughout March, all the way through the beginning of May. And then the relative started catch-up trade here, and now you have the two kind of trading right around those levels. It is interesting to think why. Are we just playing catch-up? Is there something to be said for the AI and the smartphone cycle? Or is it really just mutual funds just don't own a lot of Apple and they kind of have to own a lot of Apple? And so they're kind of readjusting as we kick off the summer, Romaine.
All right. Well, as we count you down to the close, let's kick things off here with Jeremy Siegel, Professor Emeritus of Finance at the Wharton School at the University of Pennsylvania. And Professor, we talk a lot here about kind of the hope, the promise of technology, the promise of AI. But on this same day, we're also talking about I guess some cracks, if you will, in sort of the industrial side of this economy. Piece it all together for us. What does it all mean?
Well, yes, and actually yesterday when I saw the jobless claims jump above 240, that concerned me. Now, it is a volatile series, but we are seeing softness. The technology is just sucking up all the oxygen in the room. And I think there's a little bit of FOMO going on among money managers. I mean, if they don't own, Apple, NVIDIA, or Microsoft, they're going to be falling behind. So, as we get to the end of June, that's 6 months portfolios. They've got to show that they've owning some of these stocks that have gone up so much. Yeah. So you really see a narrowing market, as you guys have described it. That's not usually a real great sign for future gains.
But when you talk, it's interesting, too, you talk about some of these money managers that, of course, have to show that they're part of the party as well. And a lot of them are still on the sidelines here. Is it too late for that? I mean, I know we sort of get into these sort of quarter-end rebalancings or window dressing, if you will. Is there even time for that, though, at this stage?
Well, the trend can continue so much longer, and it almost always continues until these stocks get overvalued and are forced to correct. But right now, I mean, listen, these stocks are delivering the bacon. They're delivering the earnings. Yeah, they're selling, I guess NVIDIA is 50 times forward. The others are more towards 35 or 40 times forward. But we all know, you talked about this as the biggest outperformance in 20 years, but it was 20 years ago when these stocks were selling at 100, 150, and even 200 times earnings, Cisco and a few of the others. So can it become even more overvalued? Oh, yeah, you bet it can.
Overall, Jeremy, we're really seeing, 27 all-time highs on the S&P this year. I mean, it gets a little ridiculous after a while. Is this just
again, it's been 20 years since I've seen, as you say, an outperformance this high, the growth stocks versus the value stocks, and I'm in favor of them because I think in the long run, they are going to outperform. But boy, it has been tough. Value managers are sitting and suffering, and some of them are just sort of maybe giving up the ghost and saying, hey, if I don't own some of these stocks, I'm just going to fall too much behind. As I say, right now in this environment where we see some softening in the real indicators, when you saw the Fed, say it was a little stubborn on how many rates it's going to cut, I actually think they're going to cut a little bit more after some of the stuff, some of the data that we've seen. You begin to wonder, should I be in small stocks? No. Should I be in cyclical stocks? No. Well, where's my refuge? My refuge is in Apple, Microsoft, and NVIDIA, and that's where the money's flowing.
Yeah, I was talking to somebody today about just the amount of retail in the market now definitely surpasses what we saw just 2 years ago. So that also moving the momentum needle. What are signs for you, Jeremy, though, of a blow-off top?
Well, you get almost a verticality of it. And, when I look at these stocks, I don't quite see that, vertical, where you see, these stocks go up 5-10% per day. Now, it's incredible to me to think of a $3 trillion stock doing that. Now, we saw, Apple in 2 days go up by 10%. That is also unprecedented. But what you usually see at that top is a big surge, everyone getting in the morning, ends down. It's called a one-day reversal. And usually that is one of the markers that shows for a top. There's usually another little rally that starts to try to make it. It doesn't quite make it. And then you see the interest fade in that group.
All right. And Professor, when we start to talk about this idea here of how the market sort of adjusts to the potential that we could actually see a pretty significant change in monetary policy later this year. We could see a significant change in economic conditions. And we're certainly, or I shouldn't say certainly, but we could see a change in our political picture as well come November. Is there any sort of incentive to be invested, any sort of in this market heading into that?
Well, right now, if you look at S&P looking forward, we're at 21, 22. That's a little on the expensive side. But you take out tech, you're on 17, 18. That's not on the expensive side. Now, that argues for not going into that. But then you look at the day-to-day performance and you say, whoa, I'm not where the action are. And that's the tension, I think, that is really bombarding so many investors. From a long-term standpoint, it looks I should be cautious on tech. But from a momentum standpoint, and boy, momentum is an important factor, certainly in the short run and even intermediate run in the market. Boy, this is a momentum-driven market. So if you're a short-term trader, you got to be where that action is.
All right, Professor, always great to talk to you. Professor Emeritus of Finance at the Wharton School over at UPenn. Jeremy Siegel there helping us kick you off to the close. When we come back, a closer look at the world of soccer, football outside the U.S. as the World Cup is coming to North America. A conversation with Dan Hunt, president of FC Dallas and chairman of Dallas's FIFA World Cup 2026 efforts.
All right, plus we're going to talk with Michele Alt. She is co-founder and managing director of Klaros Group. Her insight on how to improve the oversight of fintech companies after one collapse collapse left consumers holding the bag for millions of dollars.
And in our top calls, we're going to take a look at RH, the worst performer in the Russell 1000 here on this day as the furniture retailer reporting heavier than expected losses. Anthony Chukumba over at Loop Capital going to be stopping by the program in just a second. Stick with us. This is The Close on Bloomberg.
Adds almost $300 billion in market cap in 5 days. You got a suite of AI products at WWDC to topping Microsoft in that market cap value yesterday at the close. All right, joining us now more is Dan Ives, Wedbush Senior Equities Analyst. He currently has an outperform rating on the shares. Dan, do you think this massive, historic catch-up in market cap, is that product AI driven? Or, hey, this is mutual funds got it on the stock, they got to buy?
Well, I think this was a historical week for Cupertino and Cook, because you're unveiling now the AI strategy where I view it's going to lead to a renaissance of growth, and we think $30 to $40 per share incrementally gets added to the story. For Apple, it's 9 p.m. in this AI party that I believe lasts till 4 a.m.
9 p.m. in the AM. That is a great quote, Dan. I want to steal that puppy. What about mutual funds, though? Like, how under-owned or over-owned or normally owned is this stock?
I think it was very under-owned. I think a lot of skepticism going into even WWDC and just in general what we're seeing with Apple. But I think many have missed the forest through the trees. And look, betting against Cook and Cupertino has been the wrong move. And now, okay, you still have a tough June quarter. But when you go into iPhone 16, what we see with AI, what I saw at Apple Park, I believe it's get out the popcorn moment. I think this is the start of an AI-driven super cycle. And that's why I think a lot of the bears this week, they've gone deep into their caves in hibernation mode.
They certainly have, Dan, and I think a lot of people are looking ahead to that next big hardware release to see what the uptake is going to be. I know it's too early to kind of put numbers on that, but is AI really going to be sort of that push? The idea that those of us who maybe haven't upgraded in a while, this is going to be the thing that tips us over, AI?
Oh, I think it is. And I think that was, even though it was a delayed reaction, what Cook talked about at WWDC, because Apple Intelligence, that's really going to be for iPhone 15 and later. And if you look, and this is the most important thing, our estimates, 270 million of 1.5 billion iPhones haven't upgraded in 4+ years. That's why I believe this is going to be an unprecedented upgrade cycle next 2 years. And I believe a year from now, we are looking at a $4 trillion market cap.
Wow. $4 trillion. And you think within a year that we can get there on Apple?
I think you have 3 $4 trillion companies, the godfather of AI, Jensen, NVIDIA, Microsoft, everything Nadella, and, of course, Cook and Cupertino.
I mean, we're already kind of like, we're at 3.3 trillion, right? So it's not that far in essence. But, Dan, my question really is, when you have the overhangs, like the EU, we had a report from the FT that they're looking at potentially Apple going against their digital market laws, like stuff like that. Are these material for Apple? How do you, the notorious bull, look at that?
Look, the DOJ issue, I mean, that's something that I think is much more important, and over the next 3 to 4 years, that will be a bit of an overhang that I think eventually gets played out. But in the near term, the EU, look, getting fines and scrutiny from the EU for Apple, it's like drinking a cappuccino in the morning. That's not anything that they're not used to. So I don't really worry about that from a stock perspective. And I think right now we are on the precipice of a new age for Apple.
Wow, I don't really know where to ask after that, Dan. What are the ancillary plays then in tech for that?
Look, it's all about this AI revolution. And when you look at Apple, clearly semis, it's going to be a huge tailwind additionally to what we see from a smartphone perspective. We see that all throughout our Asia checks. And I think we are now starting to see the second, third, fourth derivatives of AI play out. But for Apple, and the reason the stock's up this week, despite skepticism going in, because the consumer AI revolution now goes through the walls of Apple.
Dan, always great to talk to you. Dan Ives there over at Wedbush. A closer look here. One of the bigger gainers here on the week. Apple down on the day, but still a phenomenal week. It, of course, hit those multiple record highs earlier this week here. And it's certainly plausible here that we could see that refresh cycle here. I mean, if this is sort of what gets it, because I think about the last few updates and you're just kind of like, I don't need an extra pixel on my camera or a slightly thinner iPhone, but maybe AI will be what entices me to upgrade.
I just took it back to those mutual funds because I was talking to Scott Rubner over at Goldman Sachs today, and he was saying that the average mutual funds hold Apple as a 250 basis point underweight. That's almost 2 times the next most underweighted stock.
Yeah.
Fancy way of saying not a lot of mutual funds own it. So if it does get a pop, at some point they're going to have to wind up getting in to show that they have it. Yeah,
they also have to show the growth, though, too, right? I mean, we know that Apple's a stable company, but one of the reasons why it has been underweight is it just doesn't have that growthiness that you see, obviously, in NVIDIA, which is the poster child for growth, but even some of the other tech companies.
So it's like the perfect storm, right? Like they had the conference, they had maybe we're looking at a real refresh cycle, et cetera, and then you have the lack of positioning coming together.
And, you know, not to be sort of the contrarian here, but they also got to get this right, too, right? I mean, they said this is coming, but what's it going to be like? You know, Siri was supposed to be great, too, and we saw how that worked out.
Well, that's true. But this is what we know about Apple, is that they're not the first mover. They're not the first mover. They're going to partner. They're going to wait and see everyone make mistakes, and they're going to go full throttle. So they don't have that kind of real mistake. And
all right. Well, we'll see maybe towards the end of the year when they make those hardware announcements, whether we get a big upfresh cycle in the hardware space. Not much of an upgrade cycle, though, going on in the furniture space. We actually had a chance to hear from RH last night. Softer demand growth and disappointing first quarter results, sending those shares down phenomenally today. The worst performer in the Russell 1000. We're going to dive a little bit deeper into it as part of our look at some of our big top calls. This is The Close on Bloomberg. All right, time now for our top calls. So look at some of the big movers on the back of analyst recommendations. And we start off with MicroStrategy. Bernstein kicking off coverage of the software company turned, well, crypto hedge fund with an outperform rating. The price target, street high, 2,890. MicroStrategy saying that it's going to offer $500 million in convertible notes to buy more Bitcoin, making it the largest publicly traded holder. Bernstein says that this can bring significant upside to its corporate strategy shares, basically flat here on the day. Next up, let's take a look at Twilio, cut to equal weight over at Morgan Stanley. The analyst still has love for Twilio, but says concern about the health of the consumer as well as softness in the enterprise space, making the communication software stock less attractive. She sees few growth catalysts over the next 12 months. Those shares down about 3%. And finally, let's take a peek at Hasbro. Bank of America not toying around, raising its recommendation to buy, with the analyst saying consensus estimates aren't taking into account the success of Hasbro's Monopoly Go mobile game. Overall, the consumer products segment is still stable, and the analyst expects that momentum to carry into 2025. Hasbro shares having a decent day, 6% higher, and those are some of our top calls. Now we want to flip to one of the biggest decliners here on the day, and that is RH, the company formerly known as Restoration Hardware, down the most since March of 2020 after reporting a heavier than expected first quarter loss. Some analysts heeding caution on softening demand and other macro pressures. Let's get some insights out of one of those analysts, Anthony Chukumba, senior research analyst at Loop Capital Markets, joining us right now. He's got a hold on RH and cut his price target today from $350 all the way down to $230. I think this earnings release and that conference call, Anthony, kind of rattled a lot of folks because RH really seemed to be knocking out of the park for so many quarters, so many years. But the last few quarters, we've heard a lot of commentary out of the CEO that things weren't that rosy. And today, or I should say last night, they really kind of dropped the bomb, basically saying that things aren't looking good and they aren't going to get better anytime soon.
That's correct. And I think that part of the problem, it wasn't just the fact that their first quarter results were disappointing, particularly from a demand perspective and from a profitability perspective, but they reiterated their full year guidance while forecasting the second quarter below expectations. So it's a little bit of a head scratcher, right? In other words, the first half is certainly going to be worse than they were initially expecting. So why are they reiterating the full year guidance? Could there be other shoes to drop here?
We've been talking so much on this program about the health of the consumer, but we've put a big focus on lower end consumers and what they're struggling with. RH caters to a much higher net worth consumer. Are you starting to see cracks in that side of the market, or is this something very specific to RH alone?
I think this is very specific to RH because even though this is a high-end consumer who still has plenty of money to spend, I mean, particularly given how strong the stock market has been, generally they're going to go to RH because they bought a second home, in some cases a third home or even a fourth home, right? Or they went from a 5,000 square foot home to a 10,000 square foot home. And so RH is very levered to existing home sales, particularly luxury existing home sales. And that market is just in a really, really bad way. And this is just not a customer who's going to go to an RH and literally spend 5 or 6 figures unless they're moving or unless they bought, like I said, that second, that third, that fourth home.
Fourth home, man, I would have so many throw pillows. Who are the real competitors to RH? I was trying to sort of suss that out. And how does the valuation then for RH, if some of that is idiosyncratic, compare to its peers?
One reason that we like RH long-term from a fundamental perspective is they don't have a whole heck of a lot of competitors. One thing that they've successfully done over the last several years by increasing the quality of the merchandise, by increasing the price points, by opening these big, beautiful stores is really, differentiating themselves from the competition. Now, on the margin, you can certainly say that Williams-Sonoma is a competitor. You can certainly say that Our House is a competitor. Those companies are generally doing better than RH right now because they're not so levered to that high-income consumer, and they're not solely reliant on these literally 5-figure and 6-figure purchases like RH is. But in a lot of ways, RH is in a class of their own. And so that's why, even with these near-term struggles, we still feel pretty good about the stock long-term.
Has RH troughed yet, or is it sort of finding its way?
I would say that it had troughed if I wasn't concerned that they're going to have to lower guidance later on this year, right? I mean, if there's one thing that investors, hate with any company, it's companies that, sort of overpromise and underdeliver. And I think with them reiterating the full year guidance, they could be setting themselves up for that.
All right, Anthony, thanks a lot. Really appreciate it. Anthony Chukumba over at Loop Capital Markets. And this is me being the indicator. I will never shop at RH. It is so expensive, even the outlet store. And this is why you'd probably long-term want to buy the stock. Yeah, it's definitely a very specific consumer. And it's not just the fact that it's expensive, but even the aesthetic. There's an appeal, but not for everybody. Let's just say that. So you kind of wonder that once you do get those customers who buy, as he said, spend 5, 6 figures to furnish their first, second, or maybe fourth home, at some point, you run out of homes to buy and furniture that you need. Yep, in theory. You just see the cycle. You see the cycle to start picking up again. Where do you shop for home goods, for furniture? Ooh, I do the outlet store of Design Within Reach in Industry City. Oh, so you are fancy. Design Within Reach. Outlet store. It's like 60% off. Right. That still means it's like $5,000 for a Eames really chair or something. You can get one for like $3,000. Anyway, coming up, the debate over fintech regulation. Michele will be joining us. This is Bloomberg.
It's going to take some time to get inflation back to 2% all the way back. So my projection is that we probably won't get there until 2026, but we'll see progress continue in my modal view. And that's enough, right, to then say, okay, it's time to start the process of bringing rates down.
Outgoing Cleveland Fed President Loretta Mester speaking with our very own Michael McKee, Romaine Bostic here. Alongside Alex Steele here, counting you down to the close, Alex. Yep, and sort of that's why you have Barclays, for example, they're going to short the 10-year Treasury in part because they see economic activity is going to rebound. They think that consensus is 2 to the upside and leading to higher rates. So the higher for longer still prevails among some strategists. They're going to be tactically short the 10-year on that. Yeah, but the traders are really trying to fight this. I mean, we're looking at, I guess, what is this? Probably the biggest drop that we've seen in yields, at least on a weekly basis, certainly all year long, but in quite some time. So you kind of have traders thinking that maybe the direction will be down, and then you hear comments out of Mester and some other folks. Exactly, and that kind of changes it. And they're saying, no, you're delusional. But again, that's been the yin-yang that we've been dealing with now for really the last year and a half amid the Fed tightening cycle, the easing cycle, and maybe what's to come next. We want to turn to the world of fintech right now. There was a bankruptcy just 2 months ago involving a company named Synapse Financial Technologies. You may not have heard of it, but it was a big middleman in the world of fintech. Basically, it's an intermediary between the fintech companies and their partner banks, the big banks. when it went bankrupt, millions of customer dollars went missing. And it's raising a big question: how can one popular online banking model fall through the regulatory cracks? It's a complicated issue, and here to help break it down for us is Michele Alt. She's a co-founder and managing director at Klaros Group. In addition, she spent more than 20 years in the law department of the U.S. Office of the Comptroller of the Currency. All right, Michele, this story caught my eye the other day because we kind of know about all of these sort of fintech middlemen, if you will. But I think a lot of people forget that a lot of them aren't beholden to the same regulatory standards that a normal bank would be. This whole business model has just blown up so much, and I'm wondering, have we gotten to the point where either that business model needs to go away or we need to see greater regulation of it?
Well, thanks for having me on, Romaine. And I would just like to say, Alex, I wish we were talking about your throw pillows and the RH outlet, because it's a lot simpler than the subject we have today, and it's of course extremely serious. So I'd like to start by saying that what happened here really is tragic. People got hurt. They got really hurt. They can't pay their mortgages. They can't pay their kids' college tuition bills. And I'm hearing from those folks, and their stories are heartbreaking. That should have never happened. But I do think that the Synapse matter is an aberration and should not result in a rush to judgment about banking as a service generally.
So for those folks here who are still wedded to this business model, and we've heard from a lot of the big banks saying they actually prefer this because it allows them to sort of shift some of the risk and responsibilities around here. Is there anything that could be done to maybe make it, I guess, to offer more protection so that if we do end up with another Synapse scenario, folks aren't going to be wondering whether they're going to get their money back?
Well, Romaine, I think that the regulators are already showing what they can and are doing here. Today, the Fed and the Arkansas banking regulator, which are the regulators of one of the main partner banks involved here, Evolve Bancorp, issued a consent order, an enforcement action against Evolve that I think provides a pretty clear indication that the regulators have been on the job here and how they approach the issues that they've uncovered.
Michele, could you just help me and dumb it down for me exactly what went wrong? Because I read this piece multiple times and I'm still not 100% sure as to like where the axis at failure was and what actually was at fault or who was at fault.
Sure. If it would help, let me describe at a basic level what banking as a service is and the basic models of banking as a service. Would that be helpful?
Yes, go for it.
Okay, so BaaS, or BaaS, depending on your accent, is a partnership between a bank and a non-bank partner to provide financial products and services to customers. That's it. In this model, the bank takes regulatory responsibility for the relationship, but gives the partner responsibility for managing a lot of the business and operations. So the bank oversees how the partner does this and conducts monitoring to make sure the partner is doing so consistent with law, regulation, and the bank's policies. And the bank also provides banking technology and connectivity to payment systems like ACH and the card networks. And banking as a service has a number of different models. And this is where it gets really confusing, Alex, so I sympathize because the terminology varies and it's actually the subject of a heated debate. But in the wake of Synapse's troubles, many commenters are focused on the distinction between direct and indirect BaaS models. So in the most basic version of the direct model, a bank develops its own technology to connect with partners and handles all aspects of the partnership, including sourcing the customers and overseeing compliance. Go ahead.
I was going to say, at the end of the day, though, isn't this all FDIC insured up to $250,000? So, like, what's the problem?
Okay, so the FDIC, yes, funds held in traditional banks are FDIC insured. The FDIC insures $250,000 per depositor per insured bank. But Alex, here's the issue. That insurance is only available when a bank fails. Here, Synapse has failed. The partner banks have not failed.
And so, Michele, that brings us back to, I think, where we started here. What are the protections going to be, if at all? Or are you just saying that we're just going to have to deal with the possibility that in the future, if this happens, that's just what happens?
Now, let's take a look again at the evolved consent order issued today to kind of give a guide for what the regulators are doing. And I can also quickly describe how I think the customers will get their money back ultimately, if that would be helpful.
Sure. We've only got 2 minutes, but go ahead.
Okay. So the consent order is saying that Evolved engaged in unsafe and unsound banking practices here, and now is requiring Evolve to get the regulators' prior approval before establishing any new fintech partners and offering new products or programs to existing partners. So the regulators are going to be watching Evolve's BaaS programs very carefully and limiting the program's growth. And that is consistent with a number of other consent orders that the regulators have issued in this space. So getting to how will they get their money back, right? So in the bankruptcy case itself, Synapse has a bankruptcy trustee, former chair of the FDIC, Yelena McWilliams, and she's proposed several possible solutions, including making partial payments to the customers. And hopefully the judge is going to sort that out soon.
Yeah.
Consumers may also find relief if the CFPB finds violation of financial consumer protection laws. The CFPB, which regulates the non-bank providers, not the banks in this case, could provide relief from its Victims Relief Fund. That's called the Civil Penalty Fund.
Right.
And that fund provides money to people who've been harmed by companies that break federal consumer financial protection laws. And most people in this space have their money on that as the eventual remedy.
All right. Well, Michele, we really appreciate you coming on to try to help explain this to us. I think it is confusing for a lot of folks, and I feel like it's a story that we'll have to talk to you about again, hopefully under more positive circumstances. Michele Alt, she's the co-founder and managing director of the investment advisory firm Klaros, and spent about 20 years as the district attorney in the Chicago office of the Comptroller of the Currency. All right, coming up here on the big program, the worst performing S&P 500 stock today. Well, you're going to find that in the industrial space. We're going to talk about what's bringing the sector down. That's our stock of the hour, and it's coming up next. This is The Close on Bloomberg. Time now for our stock of the hour. Maybe we should call it sector of the hour today here with the S&P Industrials, the worst performing of the 11 S&P sectors. And a lot of that is on the back of some disappointing pre-announcement by a huge supplier in that space, MSC Industrial. Abigail Doolittle joining us right now to talk a little bit more about what's going on. Not necessarily a household name, but they are a big supplier like metals and a lot of other stuff for factories here. Their pre-announcement kind of rattled a lot of folks. Basically, what they said was their customers have too much inventory.
Yeah, that's exactly it. They're not talking about it as they're saying that the channel needs to be destocked of products. And because of that, there's no demand. And so they had this pre-announcement. It's a pretty bad one, too, not relative to revenues. Well, revenues a little bit, $22 million light. But for adjusted earnings, the street was expecting $1.50. They're saying they're going to do closer to $1.32, something like that. So I think that the bigger thing that's interesting here is the question on the economy, because there are some signals that the economy is fine and the idea that the Fed has manufactured this soft landing. On the other hand, like you said, I've never really thought about this company all that much. I'm looking at their website right now, though, and you're right. They sell everything. Abrasives, clamping, fasteners, basically all of these items that help businesses and manufacturers run. So if the backbone of the economy is seeing this kind of a glut in there because of a lack of demand, what does that say about the economy? I mean, I think that's really the bigger question. And it's not just them. Lincoln Electric, ASAB, people are looking for Parker Hannifin. Are they going to guide down when they report later this year?
And also, this is an early cycle industrial, too. So that's the first is going to get hit in terms of any demand worries. But I was just looking at a chart here that if you take a look at a chart of that stock versus, say, the ISM manufacturing new orders data, I mean, they're both pointing straight down. So in terms of the ISM manufacturing numbers, I mean, that's kind of been what we're saying, sort of below 50, below that growth level.
Well, it's interesting what you're saying, Alex, because Mike McGlone, our commodities analyst for a long time, he's been saying that the weakness that we had in commodities last year, that was a signal we were going to see some sort of a recession this year. Now, again, the narrative has shifted toward the idea that the Fed has manufactured this soft landing. But if you take a look at copper, if you take a look at oil, you take a look at the grains, they're at lows. He's saying that they're going to go lower and then it's going to be demand driven. That would be consistent with what you're talking about here, that this is an early stage. So these might be the early signs that not all is well. These are not the traditional recession indicators. And I did find one, though. I'm not exactly sure how to say this, but the Shinep recession indicator, apparently it's flashing red and that it's pretty accurate within 6 weeks of predicting a recession. I have a hard time believing that's going to be the case. That would be kind of the floor falling out. But again, there's signals to watch here that maybe the economy is not as strong as we all think.
All right, Abigail, thanks a lot. Really appreciate it, Abigail Doolittle, joining us there. It definitely feels like we've been in the trough of manufacturing for a while. So when we're going to find that base and when we're going to actively wind up recovering. All right, coming up, we're going to continue to count you down to the closing bells. John Kosovos is Chief Technical Strategist over at Macro Risk Advisors. It's been quite a week. All you have to do is ask Apple shareholders. This is Bloomberg.
The technology is just sucking up all the oxygen in the room. And I think there's a little bit of FOMO going on among money managers. I mean, if they don't own, Apple, NVIDIA, or Microsoft, they're going to be falling behind. You really see a narrowing market, as you guys have described it. That's not usually a real great sign for future gains.
Professor Jeremy Siegel there, talking the tech rally earlier here as we started off, counting you down to the close. I'm Romaine Bostic alongside Alex Steele. A record week for U.S. equities, though. The moves today here, not necessarily reflective of what we saw the past four.
Yeah, today's not great, but overall, like you were mentioning, you're still S&P up on the week, 2 straight weeks in a row. The Russell, though, doing okay, just down about 1% on the week. Obviously having a tough day today, but the last 2 weeks, the Russell was trading a little heavy. Can we talk about Apple for a second?
Sure.
So Apple's up almost 8% on the week, record high after record high. This is 5 straight weeks of increases. Haven't seen that since December of last year.
Yeah, and remember, I mean, it was just a few weeks ago we were talking about this being one of the big laggards, at least among the big cap tech names here, and now kind of reasserting itself and showing, why it's Apple.
Yeah, exactly.
All right, for more market analysis, let's get right to it with John Kosovos, Chief Technical Strategist over at Macro Risk Advisors, as we count you down to the closing bells here with just about 8 minutes to go. And John, we talk about the record high on Monday, Tuesday, Wednesday, Thursday, a bit of a pullback today here. Is the momentum still in favor of the bulls as we head into next week?
Yeah, I think so to a certain extent. And again, we got to be careful how we define the market. But for the S&P 500 itself, nothing really too much to complain about it. Up and to the right, here's the higher highs and higher lows, above moving averages. They're all sloping up. It's fine. Yeah. What I am worried about is what we've seen this week, particularly with the macro trends, very, very strong dollar, what's going on over in Europe. Those moves have me concerned, to say the least. And when I'm trying to thread the needle and you ask me for next week, I'm not quite sure exactly for next week, but what I think could very well be happening, and I wouldn't be surprised, is we're getting very close to the peak in the S&P for the summer. For the summer? For the year? Yeah. Too? No, not for the year yet. I think we get another push higher. I mean, I'm not going to rule out a 5,700 handle on the S&P by the end of the year, but I think we're getting very close to another sort of consolidation range for the S&P.
All right, so what does that look like? So we're near the peak for short term, then what happens, and then when we pick up again?
Well, it'll be a couple things, right? It's hard to have that crystal ball, but my best guess is it's going to be lining up a lot around the election. So a lot of the seasonality work that I've done does suggest that the market can kind of just grind-ish, between now and middle of August, and then have a nice little swoosh at that point. It'll be, more like towards the end of the year sort of thing where you're going to want to be buying again. So that's kind of the general trajectory that I'm thinking. Consolidative, not bearish, but more consolidative.
Just nuanced. Let's take a look at breadth for a second. As tech continues to outperform, then we continue to talk about breadth. Banks in particular have just really not participated recently. What does your breadth indicator look like? Is that a concern?
Breath. Oh my God! If you have an hour, let's talk about breath.
You got like a couple minutes?
Yeah, sure. Yeah. So it was great to see the professor talk about breath before. That's fantastic. I'm glad everybody's talking about breath. That's what technicians do. We talk about breath. It is a concern, yes. But much like monetary policy, there's long and variable lags when it comes to market breadth. They're not timing tools. They kind of explain the condition. So just kind of think of between 1998 and 2000, breadth was awful during that time. But the S&P went up 50, 60, almost 70%. So you got to be careful with that. Really what breadth should be telling you is how you should be positioned. And your positioning is towards your momentum winners. Those are actually driving the index higher.
What about semis? If you just take a look, maybe drill in within tech, what about the semiconductor index?
Yeah, so this is where things get a little bit dicey. And that's part of my cautiousness going into this part of the summer. Semis, longer term, looks great. You know, I have a chart that goes back to 1969. There was a nice breakout that we saw in 2020, which was a 20-year breakout in itself. So think about it, a 20-year breakout for any security is very meaningful. And according to that simple chart interpretation, there's still another like 80% upside on semis. This is longer term, right? Not next week, not this year, over the next couple of years. But on a shorter term basis, overbought, heck yes, right? I look at a measure at its deviation versus its 50-month moving average. It's 130% above that moving average. And in the 90s, when semis got to that threshold, they were at risk for about a 20% pullback. And that lasted anywhere between 3 to 6 months. But it was supported by that 50-month moving average. So long as that moving average holds, we're going to be accumulating semis, going forward for the next couple of years.
John, we've been remiss in having this conversation solely about the big moves in the equity markets this week. We had big moves in the Treasury space as well. I believe it is the biggest week overall in terms of the drop in yields that we saw all year long here. There's been a lot of talk here about not just the directionality, but the entry points here. When you look at a 10-year yield right now, sitting at right around 4.2%, and a 2-year right around 4.7 here, do you see a tradable opportunity at that level?
Yeah, I think right now with the 10-year, you have to be long treasuries with this week's break underneath 430. So that was an important support level on the yields. That's now enough to be at least long treasuries at that point. Next support on the 10-year, somewhere closer to around 4%. I personally, what I've been trying to do in my research with my clients is thread the needle to 3.5 to 3.25 on the 10-year. I do believe that yields peaked in October 23 at around 5%. Now we're trying to thread that needle to that lower low. But for the intermediate term, I think you can start buying treasuries on that end of it. For the 2-year, support is somewhere around that 460 area. That's the next level there. Not as clean as a buy signal, but a buy signal nonetheless.
It gets to a question, too, about correlations. I mean, when you're looking at some of these technical moves here, I know some of the traditional correlations, particularly between stocks and bonds, and even with the dollar and FX overall, some of those things have broken down. They're not necessarily as strong a signal as they used to be here. When does, if at all, that become more of a factor when you're looking at what's going on in the equity space?
I think that's a great point. Correlations come and correlations go, right? Now, correlations are not static, and I am noticing changes in these correlations. And one in particular is this one, is that this week we saw a massive breakdown and break evens, right? Inflation expectations on CPI, massive break. But low beta stocks are still outperforming. And that to me is a sign that growth is a bigger concern now in the marketplace. The dollar, right? Sticky strong, okay. But what's going on with everything else? So how about yields breaking down? So the Goldilocks, this technical Goldilocks that I've been looking for is not there. I've been writing under 430 technical Goldilocks, right? But credit spreads are starting to widen. Financial conditions are starting to tighten. And that to me is a concern. And it goes back to my cautious stance here going through the summer. How you break these breadth divergences, like we saw in 2000, it's from growth deteriorating. It's because the Fed has to cut rates because it has to, not because it needs to.
All right, John, got to leave it there. Great to talk to you, Chief Technical Strategist over at Macro Risk Advisors, as we count you down to the closing bell. Just about 2 minutes to go. Right now, you are in the midst of the most important hour of the trading day, the closing bell right around the corner. Stick with us. This is Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic and Alex Steele taking you through the closing bell. A global simulcast up ahead here of today's market moves with Scarlett Fu here in the TV studio, Carol Massar and Tim Stenevik in the radio booth as we welcome our audiences across all of our Bloomberg platforms. Carol Massar here on a somewhat sleepy Friday afternoon.
I know. I'm calling it a meh Friday, right, in terms of the market trade. But we've had quite the week. Meh? It's a thing.
Okay. Technical term, I believe.
I mean, what? We've had record runs on the equity side of things up to today. Maybe on the NASDAQ we might see it again. But we've also seen a big rates coming down. We had consumer sentiment, some weakness again today, pushing pressure on yields even lower. So, yeah. We're taking a breather ahead of the weekend.
It was interesting to see the narrative kind of emerge overnight about concern about what's happening in France, geopolitical concerns in Europe with those parliamentary elections. But it does seem investors are a little on edge, but still today's move's kind of muted.
I wouldn't say that they're on edge, given that the S&P 500 is pretty much still holding at its record high. In fact, if anything, I'm kind of impressed with how resilient it is, given a lot of the headlines and the talk about all this uncertainty. You still have everything kind of valued where they were when everyone was excited.
It definitely feels it's more truncated, right? Like the CAC 40, to Tim's point, erased gains for the year. It got hit pretty hard, but that's very much somewhat concentrated on that level. What did participate, though, is the buying into the Treasury curve, right? Like that's your safe haven. That's what you're getting.
Yeah, obviously you saw the strength there in treasuries with yields dropping here, strength in the dollar here. The VIX elevated slightly, but still below that 13 level. And as Carol Massar was just alluding to, equities taking a little bit of a breather after hitting record highs, at least for the S&P and NASDAQ in the first 4 trading days of the week. Looks like we're going to get a little bit of a pullback, at least on the S&P. Right now, the S&P 500 is down about 1 point. Now, it takes a while for these numbers to settle, but that would basically make it unchanged on the day. Keep an eye on the screen because that could flip at any second. The Dow Jones Industrial Average will definitely close lower here on the day, down about 0.1% here on the day, though the NASDAQ Composite holding into the green here. You got a nice bid today on the back of some of those tech stocks, up 0.1%. The NASDAQ 100 up 0.4%. But the big laggards on the day were in the industrial and cyclical space. Transports down 1%. The Russell 2000 down 1.6.
Like I said, meh, at least on the equity side of things. All right, let's get to some of the individual. Actually, we're going to talk about the S&P 500. You will see in terms of the tone, guys, most of the names lower in today's session. 370 to the downside, Scarlett. 131 actually gaining some ground.
All right, and of course, Romaine mentioned the industrials. They are the leading laggards here in the S&P 500, down more than 1%. You have materials and energy, so the commodity-linked names also on the weak side, losing 0.8 and 0.9%. The green slices of that pie, communication services, tech, and consumer staples, although consumer staples basically unchanged. So we're really talking about tech and communication services.
Really random, but I would love a slice of pie right now. All right, let's get to Adobe. I'm kind of hungry.
It would help you not be meh.
No, exactly. All right, Adobe, certainly an outperformer in today's session. Number one gainer in the S&P 500 and the NASDAQ 100, finishing just off its highs, guys, but just below a 15% gain in today's session, up the most since March of 2020. The company, we know the deal, right? We were breaking it down last night. Strong future sales for its creative products, suggesting customers are adopting the company's new AI-based tools. So pretty exciting. Investors moving into that way in a big way. Let's get to Netflix, an outperformer, up about 2.5% in today's session, highest since about November of 2021. It is up now about 40% year to date. KeyBank Capital Markets out with a report saying his firm's latest media survey showed increasing usage of the Netflix service by its members, always important. Reiterated his overweight or buy on the stock, upped his price target to $707 a share from $705. So a slight tweaking, if you will. Stock closing at about 669 and change today.
Can I say, you know what we've noticed at home? That anytime we log into Netflix now, we pay the higher tier to not get the ads, but every time we log in, they give us a pop-up asking if we want to go down to the ad tier.
Really?
Yeah, which I think is interesting. So
that is really weird.
I don't know why they're trying to push us there. Maybe it's more economical.
Because they probably want to show that their ads are worthy of something. That people are actually watching the ads.
They want to show growth in that category.
Yeah.
Oh, okay. All right.
That's funny.
It's a move, yeah.
Great question. Nice little conversation there. All right, let's get to Hasbro. Sorry.
Is she being facetious?
I'm still looking at.
Has she started drinking early, Tim?
I don't know what's going on.
That were the case. Hasbro up about 6% in today's session. Number two gainer in the S&P 500. B of A analyst coming out raising the recommendation on the toy company to buy from neutral. So this one certainly an outperformer. All right. over to Mr. Stanovic.
I want more gainers, Carol.
Nope, I'm done.
Okay. All right. Do you want to start with shares of Apple?
It's a 3-gainer type
Worth
of
checking
day.
in on what happened this week, okay? Down by 0.8% today. But the reason I'm talking about it is because there was a bit of news from the European Commission that they plan to, well, it's from Financial Times, I should say. The European Commission plans to allege that Apple stifles competition on its mobile app store, citing 3 people with close knowledge of the investigation. The thing about Apple is the moves from the post that article were not actually big. They were pretty muted. So nothing big to report there. The bigger move with Apple is what happened this week. Shares up around 8% so far this week after the WWDC conference on Monday, where Apple unveiled that new the new AI features for its new operating system. Apple shares up close to 30% from their April lows. So it's been quite a big rebound in a very short period of time. Do you want to talk RH, the company formerly known as Restoration Hardware, having its worst single day going back 4 years to 2020, down 17%. Shares plunged after the company reported a heavier than expected first quarter loss. Said first quarter adjusted loss per share was 40 cents. Estimates were for 9.2 cents per share. The guidance for its adjusted operating margin also came in quite a bit below estimates. Price targets at Wedbush, Bank of America as well. And then the cruise operators in the S&P 500, Norwegian and Carnival Cruise were at the bottom. It was interesting. There was just a note out from Bank of America today that said that recent data showed modestly softer pricing. Andrew Dodora over at B of A wrote a note that cruise prices in early June were modestly softer in ocean markets relative to early May. It's why we saw a sell-off. Carnival down 7%, Norwegian down 7.5%. Truist said that potential restrictions on islands in Greece could be an issue, but also said that the stock sell-off seemed excessive. But this was surprising to me that note would prompt a sell-off like this.
But you know what outperformed? Alaskan Cruise. The pricing for Alaskan Cruise actually continued to outperform. So they're going, it's just being a little bit more
That's an older
discerning.
cohort, though. That's the ones who go on the Alaska Cruise, right?
Who have the money to do this stuff.
And the time.
and the time to do that. All right, let's get to the bond market here, guys, because we did see a lot of buying come in pretty much across the curve. You could say some of it's going to be Fed-related. Some of it will be safe haven as flows from Europe and sort of the anxiety there. But yields were down about 22 basis points on the week. That's a pretty chunky move there, guys, on the 10-year.
Yeah, massive. Pretty impressive. All right, let's get to something that's really important. I'm not sure it was discussed at the Fed meeting. Probably not. But shorts at the office, yes? Show of hands.
Jay Powell wearing shorts at the office.
Like wearing them? Like wearing shorts at the office?
Shorts. Go anywhere you want. Shorts, yes or no?
What stock are we shorting? I'm confused.
No, I'm talking about, Bermuda, cargo, those kind of shorts. Apparently, if you're on the West Coast, it's kind of normal, but if you're here in the Northeast...
They also wear hoodies.
Can I just say, I don't want to put Tim on blast here, but every day...
Do I have to turn this car around?
Every day I see Tim walking around in his shorts.
I know.
So, Tim, you should have raised your hand there.
Yeah.
Okay, but to be fair, he changes. He bikes in and then he changes. I got you, Tim.
That's
the context.
Hand the camera down. I want to know.
The reason we're talking about this is because one of the most read stories on the terminal today is from Sarah Green Carmichael. She's the Bloomberg opinion contributor. She writes about workplaces. She writes about work culture. And she talks about the changing idea of what is acceptable and what's not acceptable at the office. And I got to tell you guys, some people saying shorts are okay.
No. Oh, if you work in a gym, yeah.
Or if you work at home, you can wear shorts.
Or at home, right.
That is, and that's what we saw throughout the pandemic.
Exactly.
In fact, there's another great story this week that Wells Fargo, I mean, this part isn't great, but it fired more than a dozen employees last month after investigating claims that they were faking work. There are allegations of simulation of keyboard activity. So here's where life imitates art, because in The Simpsons, in season 7, there was an episode where Homer gains a ton of weight so he can qualify for disability status and work from home status, and he uses a drinking bird to tap the Y key on his keyboard because he's a nuclear power inspector, and that's what he needed to do, just tap Y. He also used the end of a broomstick to do the same thing while watching television. Again, he gained a lot of weight, so he was wearing a muumuu and sitting on the couch watching TV.
Okay, guys, for context, Scarlett has been working on this for like 24 hours, okay? Because when the story came out yesterday, she's like, guys, we got to do it. She found the graphics, she found the GIFs, she made it all happen.
The Simpsons again.
I was joking with her before the show. I was like, you've spent all day on this, haven't you? She's like, totally.
What I love about this, too, and by the way, great video there, is just how more sophisticated it's got. I mean, Wells Fargo didn't say exactly what they're using, but I've seen these devices. You can buy them on Amazon or anywhere else now.
Not the drinking
so
bird.
it's more sophisticated, so you can just log into your Zoom or your Microsoft Teams or whatever, and it makes you look like, you're just staring at the screen, working away.
But the drinking bird.
We got
Mouse
you. We got
movers.
you. I got you.
Oh
We just need one for the mouse.
goodness.
Hit the mouse. Hit the mouse. There you go.
No shorts and no mouse movers. That's, I guess, the bottom line. All right, guys, have a great weekend, a safe weekend. Enjoy. That will do it for our cross-platform coverage. Radio, TV, YouTube, Bloomberg Originals. It is the closing bell. We will see you all on Monday.
All right, stick with us here on Bloomberg Television. A lot more coverage coming up, including a closer look at the world of soccer. The World Cup is going to land in North America, and we're going to talk to one of the people behind bringing it here. Dan Hunt, president of FC Dallas, is going to be stopping by the program in just a second. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostick, closing out a wild week for equity markets and treasuries alike. You look at the screen behind me, and it really doesn't reflect all that really happened this week. The S&P closing flat on the day. The NASDAQ slightly higher here, but you're looking at what was a record run here for the S&P and NASDAQ all week long. In fact, the outperformance of tech relative to the broader market, the biggest outperformance that we've had going back to 2002. And that could be a problem. You see that reflected on the third line of the screen there. Dow Transport's down 1% here on the day. The Russell 2000 down almost 2%. It looks like some of the industrial companies, Scarlett, are maybe getting left behind.
Yeah, I've got two movers that really illustrate that divergence you were just talking about here. The first one is MSC Industrial. The ticker is MSM, falling the most since March 2020, losing a tenth of its market value today. This is a distributor of metalworking products, and it closed at a 15-month low. It pre-announced disappointing third quarter results and cut its full year margin forecast. Now, the concern here is that the CEO blamed softness in heavy manufacturing, not a great sign for the overall economy. On the flip side, tech was doing better, and Adobe is a great example of why. 14.5% gain on the day, best performer in the S&P 500 today after projecting strong future sales for its creative products, a real sign here that customers are adopting its AI-specific tools. Now, let's move along to our top story this hour, and that is the relationship status of democracy and markets. What is it? Well, it's complicated. Elections don't usually matter all that much to the day-to-day moves in asset prices until they do. And we've seen that play out in emerging markets this month, particularly in Mexico and India. To a large extent, the outsized reactions may be due to outsized gains in the lead up to the actual elections, but they do leave investors wondering, what now?
All right, well, let's pose that question to our first guest here at the top of the hour. Afsaneh Beschloss joining us right now. She's the founder and CEO of Rock Creek and spent quite a bit of time at the CIO over at the World Bank. Afsaneh, when you look at some of the election results that we got over the last couple of weeks, which was a surprise to a lot of folks, not necessarily who won at the top, but certainly the complexion of their legislatures or respective parliaments here, does it give you a sense here that maybe investors need to prepare themselves for meaningful changes in global policies?
You're so right, Romaine. And we have so many elections still coming this year, except, of course, the biggest one being in the U.S. As we saw last week with Prime Minister Modi's big surprise, we saw the markets react to it. We saw it, of course, come back in India. But the big moves, as you said, were in Mexico and in South Africa, where the currency got a hit, the markets all got a hit. And I think that's sort of part of a broader theme of uncertainty in emerging markets that is impacting emerging market performance across the board, with some exceptions, of course. And last but not least, this week's elections in Europe certainly had a huge impact. So it's not just in emerging markets that we're seeing the impact of elections, but in France and the European elections, we saw huge impact that is continuing through the end of this week.
Of course, some of the political issues, of course, drove some of the trade that we saw in EM, as well as in the developed markets as well over the last couple of weeks. The rate picture, the global rate picture also factored into that, of course, as we had a couple of big meetings from the Fed this week and the ECB last week. How does that factor into your outlook for emerging market assets for the rest of the year and into 2025?
So as we look at emerging markets, obviously what has happened with the Fed speak this week, it has continued to strengthen the US dollar versus most currencies in emerging markets. So with some few exceptions, I should say. And a lot of people who had hedges with the other way around have started taking them off. But I think the bigger issue in terms of flows into emerging markets is that there continues to be a big outflow out of emerging markets, and U.S. is the big beneficiary. The things that we're seeing the momentum with, of course, inflation numbers being where they are today in the U.S., the other issues, which is you talked about a little earlier, which is AI and the things that are impacting U.S. companies, with also political risk in emerging markets. What we're seeing is that none of these things are helping EM as a category and as an asset class. So there are flows out of not just equity markets, but out of broadly bond markets in EM. And currencies broadly weakening. The interesting thing, of course, is that there's a lot of dispersion. India, despite the election results we saw, still continues to be up 4 or 5% for the year, and it continues to be up for 3 years, 5 years, 10 years, if we look at it. So India seems to be an outlier when we look over long term, and of course Taiwan because of TSMC.
Yeah, well, India has the number one benefit of it's not China as well. We know France is not an emerging market, but Emmanuel Macron's decision to call a snap election makes the resultant sell-off in French bonds and French stocks kind of a familiar sight to emerging market investors. And we've seen that anxiety spread to the euro as well. How are you thinking about the market impact, particularly as it extends to kind of gaming out what it might mean for financial policy or energy policy in Europe?
So in Europe, as you mentioned, with the snap election that President Macron just announced, there is more fear of what's going to happen beyond the election results we saw, which move things to the right. And I think what is happening is capital that had started moving a little bit into Europe as a diversifier last year is sort of holding back. Obviously, the interest rates going down earlier in Europe versus the U.S. will help their exports a little bit more. But so far, that has not been enough. And as you said, I think the bigger political picture in Europe remains relatively murky. We saw, for example, today, Germany starting to maybe move away from some of the conversations earlier about Chinese EV cars. And that remains to be seen because that is such a big part of European exports. And having clean energy in Europe has been such an important part of their policies, and they have really not been that great since COVID.
Yeah, all great points. I look at what did gain today, and you have gold prices up 1.25%. How do you think about a safe haven in a 2024 election year where there have been so many surprises?
You know, it's interesting because gold prices obviously have been up for a number of reasons, including central banks in some of the emerging markets holding on to more gold versus other things post what happened in Russia and its experience with its reserves. The Chinese are nervous about their own reserves. So gold has had there's a lot of reasons for gold getting impacted. I don't mean just in the last week, but longer term. What is interesting, I think, is really the big thing still remain to be what people are saying. U.S. is the safe place, relatively speaking. Obviously, as we get closer to our election, there will be an impact, and VIX remains to be at its lowest levels. And then because of AI and the impact of AI on markets and changing things about markets. And then last but not least, you mentioned energy a second ago. Obviously, AI has a huge energy impact. And what we saw, for example, today with Constellation Energy being up, a large part of that being the fact that it's nuclear energy as a diversifier again in energy.
All right, always looking for that diversifier angle. Afsaneh Beschloss, thank you so much for joining us today. Afsaneh Beschloss is founder and CEO of Rock Creek. Now, still to come on The Close, from Shark Tank to success. We'll talk to the president and CEO of Transformation Factory about one of the hottest commodities for health and fitness. This is The Close.
All right, it's time now for our Next Up segment. This is where we highlight the entrepreneurs and founders that are really moving the needle for our economy, the markets, and technology. Our next guest is marketing his product as a must-have for those folks out there seeking a healthier lifestyle. Joining us right now is Alexiou Gibson. He's the CEO and president of Transformation Factory. That may not mean much to you, but how about the words CMOS?
Yes.
Look, we should just point out, for a certain part of American culture, CMOS has been a popular thing.
Absolutely.
It gained sort of renewed attention during the pandemic when people were really looking for ways to boost their immune system. Just explain for the viewers exactly what CMOS is.
All right, great.
Yeah.
So CMOS is a supermarine algae that grows in the ocean. It's a plant, and it carries over 60 plus minerals in it for the human body. So you have potassium, zinc, vitamin K, A, all these different things. And what we've done is we've produced a product where you just take 2 tablespoons of a concentrated gel a day to get all of the vital nutrients that your human body needs. So during the pandemic, the pandemic when COVID was a respiratory issue. It made it hard to breathe, hard to eat, smell, all these things. And CMOS greatly increases the immune system of the body so that it can fight off these diseases.
Talk about the pitch on this. A lot of people know your name and face from the TV show Shark Tank.
Yes.
You were able to win an investment after that show with Mark Cuban as well as with the comedian Kevin Hart.
Yes, that's correct. So went on the show, pitched. We had 4 sharks actually offer us a deal, and I decided to go with Mark Cuban and Kevin Hart. They
Good choice. The other 3, I don't know about that. Yeah.
Everyone was so kind and influential and knowledgeable, but I went there wanting Mark from the beginning. He was like a wish list for me. But he technically always invests in technology companies, so I knew with me with a supplement brand, it would have been a stretch. But he came back at the end of the show and nudged Kevin Hart and said, "Hey, let's do this together." And I was like, "There's no way I could say no to that."
No, it'd be hard to say no to that. So CMOS is available in gel form, capsule form, and gummy form, and now in drink form.
Yes.
Why the move to a drink form? What did you see out there from your customers, from the market, that convinced you that this is another way to provide CMOS?
Yes. Well, we actually don't have a drink yet, but we are planning on launching, as well as a skincare line, because it's so good for your skin. But to answer your question, it's just more convenient. You're rushing out of the house, you're going to the gym, you can just grab a drink or, grab a couple gummies, they taste like movie gummies, like from the movies. They're really delicious. You almost have to stop yourself.
Because CMOS on its own isn't very palatable to the taste.
and this is why our company rose to fame so quickly, is because we took something that's typically fishy and salty and made it into the Bahama Mama CMOS, strawberry banana CMOS, where the babies are eating it like it's baby food, and parents are saying, "Hey, just 1 tablespoon." It's actually a supplement.
Not too much.
Yeah, not too much. So we try to make it very enjoyable and delicious to taste, because the history of it is it comes from the ocean. Who wants to eat something fishy? Yeah. No matter how healthy it is. But
so you are direct to consumer right now. That means people have to order it on the internet.
Yes.
They don't get a chance to sample it necessarily. Do you have any plans to make it available through brick and mortar stores?
Oh, absolutely. So we're actually opening the world's largest CMOS factory in a few weeks. It's been over a year in the making. And with that 20,000 square foot facility, we'll be able to mass produce our products. We have German-made machinery that's helping us co-pack and make and pack orders quicker so that we can make enough. Because, if Target calls and says, "Hey, I need 100,000 jars," right now we're making about 5,000 jars a day.
Is Target doing that?
Well, yes, we have gotten calls from Target, GNC, QVC, and HSN, and we just recently got nominated for Oprah's Favorite Things. So,
That's a game changer.
Q4 is going to be a game changer for us, and it's like, how do we make enough product in time? So once we can make enough product, then we can start to get into the Whole Foods and the big brick and mortar stores.
I have to ask you, similar to one of the sharks would ask you, about competition. I mean, it seemed like a few years ago this was a relatively obscure product. You had to go into certain communities here in the U.S. to even find it. Now I see it everywhere. I see it at Whole Foods, not necessarily your brand, but I see other brands on the shelves now. So there are other people now trying to do this as well here.
Yes.
I mean, but how are you going to navigate that, right? Because it's one thing to be the first mover. It's another thing when everybody else starts crowding into the space.
Well, what I would say is we have a personal relationship with our customers, and we're called the Transformation Factory because because of my transformation. I used to be over 540 pounds, and I've lost over 200 pounds. And with us, you're not just buying the product, you're buying into a community where we're there to help you, guide you, and we're going to expound on that. You know, having workouts and meal preps and all these different things to help people transform into the best versions of themselves. So when you talk about competition, everyone can make CMOS. You know, we even teach our customers how to make their own CMOS, but we're bringing a community and a transformation aspect to it that will make it more personal.
All right, Alexiou, this was a fascinating conversation. This is Alexiou Gibson. He's the CEO and president of a company called Transformation Factory, trying to bring CMOS to the masses. When we return, we're going to talk about the NBA Finals, Scarlett. You know, they are as a big game later tonight. Well, I want to go all the way back to 1998. Of course you do. To my favorite moment in time, Game 6. Swish. All right, it's that time of the show where I get to indulge my nostalgia because it was on this day, June 14th, 1998, the Chicago Bulls won their third straight professional basketball title and their sixth championship in 8 seasons. It was a defeat of the Utah Jazz, punctuated by Michael Jordan's iconic game-winning basket. A flat-footed jumper from the top of the key, defender Byron Russell slipping on the floor, the basketball just swishing through the net, Jordan finishing in that motionless pose, wrist still cocked in the air, watching his Bulls take a 1-point lead with 5 seconds left in regulation. ESPN ranked that shot as one of the 50 greatest sports plays of all time. NBC saw a record TV viewership with an average of 36 million people in the U.S. tuning in. It was then and is still now the most watched game in the history of the NBA. To put those 36 million viewers in perspective, ABC and ESPN said that this year's NBA Finals between the Boston Celtics and Dallas Mavericks is drawing about 11 million viewers on average. Game 6 back in 1998 would end up being even more significant than just ratings. A few months later, it would prove to be the last shot that Jordan would ever take in a Bulls uniform. News of his retirement sent ripples through the sports world and corporate America as well. A Fortune magazine study at the time estimated that Jordan alone was worth $10 billion to the NBA since he was drafted back in 1984. His Game 6 performance would mark a peak, though, for the NBA. Ratings slowly fell over the years, league revenue plateaued for some time, and the share prices of some of the companies he endorsed plunged in the days leading up to and immediately after his retirement announcement. That included shares of Nike, MCI WorldCom, Sara Lee, and even Gatorade maker Quaker Oats. It was a lesson in the double-edged sword of building a brand, building a fan base, and building a league around a singular, iconic figure, a figure whose presence and success can lift all boats, but whose departure can have the opposite effect as well.
That's a perfect example of key man risk there for the NBA when all was resting on Michael Jordan's laurels. All right, let's stick with sports here because all eyes are focused on soccer this month. The European Championship kicked off today in a match between Germany and Scotland. American soccer teams are hoping that excitement will translate in this part of the world, leading up to North America's hosting of the World Cup in 2026. Joining us now from Texas, Dan Hunt, president of FC Dallas and chairman of Dallas's FIFA World Cup 2026 efforts. Dan, so good to speak with you.
Nice to see you guys again.
So you and your brother Clark played big roles in bringing the World Cup to North America for the 2026 World Cup. Clark has said that the 1994 World Cup, the last time the U.S. hosted, was the most successful World Cup ever financially. So I'm curious to hear from you what learnings you're taking from 30 years ago that you'll be applying and approving upon in 2026.
Yeah, this is the best sports market in the entire world. We're so innovative, the way we sell tickets, sell sponsorships, media rights. And you're right, the 1994 World Cup was the most financially successful of all time, and that was with a much smaller tournament. Now we're going to have 48 teams, 104 matches. There will be somewhere between 7 and 8 million tickets in the ecosystem. So I can't even imagine what the revenue will be like this. And most of the matches will be played in NFL stadiums. And the NFL is arguably, or if not the most successful sports league in the entire world. So I think taking those learnings and marrying it with soccer on a global stage in its most grand scale, I think we're going to see a financial outcome that nobody could expect.
And then you add American marketing dazzle to that effort as well. The Toyota Stadium where Dallas FC plays will be a training venue location. I want to go broader here and talk a little bit about MLS overall, because if you think about sports, it's really a media rights story. And we know that Apple began airing live MLS games back in 2023. From where you sit, what have been the benefits of this partnership? How has it shown up for Dallas FC?
Yeah, look, Apple is one of the greatest companies in the entire world. And if you take their technology spin, they've really enhanced the game day experience for fans to watch. And you can watch so many games now. It's on-demand viewing with specific time slots. And for us specifically in Dallas, as we think about renovating Toyota Stadium, which we're working on over the next couple of years, there are certain things being an older stadium that are challenges. And I'll pick on the lighting to start with. We didn't change any of the lights at the stadium, but if you look at the clarity and the broadcast that Apple puts forth, and then how that marries with different atmospheres of different stadiums around the league too, the quality of the in-game experience is so much better for fans, fans watching at home, and also the talent, the studios, the wraparound shows that they do. Apple has really changed how we think about broadcasting sports, and and it's in multiple languages. It's English and Spanish now. We'll be heading to French, or we're also in French for the Canadian teams, and going to Portuguese. And so this will be broadcast, right now at 106 countries around the world. They've made MLS a household name for the globe, and it also doesn't hurt to have Lionel Messi.
Absolutely. I am curious, Dan, going back to the World Cup in a couple of years here and some of the changes that you are making in preparation for that. I mean, obviously, it's a much different animal when you're dealing with a big international event as opposed to just, say, bringing in fans from, the greater Dallas area. When you're dealing with all these different folks with different languages and different cultures all congregating at once here, what type of accommodations have you had to talk about to make sure the stadiums and the surrounding areas are prepared for?
Yeah, look, there are so many things that go into putting on a World Cup. Dallas is the perfect city for it with two major airports. And also you look at the hotels, the affordability, the facilities. Public transportation is a big deal, and each of these communities has a different spin on it. We have a great commitment in Dallas from the Public Transportation Authority. If you have a game ticket or have a ticket to one of the other events, you'll have free transit to go to those events. And I think it's just a bit of a process, right? But Dallas is a global city. Most of these cities are now global cities. And so you have a lot of different language speakers here. But the key to these events is the volunteers. There will be thousands and thousands of volunteers, and hopefully they'll be able to facilitate a great experience for visitors. We've worked really hard with Dallas-Fort Worth International Airport, too, and how they're going to facilitate that experience for fans coming through. Obviously, customs is a gigantic issue in a lot of these markets. You'll have a number of travelers entering in these major cities, either on public transportation or private aircraft. And these are all things that we have to sort through in this experience. And it's not really the summer of soccer. We're really now in the 2-year window of soccer. One of the most amazing times, I think, in the history of soccer in this country. And, on the women's side, we see NWSL with unprecedented growth. So this is such a great moment to be involved in the beautiful game. I wish my father, Lamar, was still alive to see it. He worked so hard to make it work in this country, and was really one of the founding fathers of the modern professional game. He was chairman of the Dallas bid in 1994, and his beloved Kansas City now also is going to have games with my brother Clark as the chairman for that.
Yeah, and of course, I know that you just got your Super Bowl ring because of your involvement with the Chiefs, so congratulations on that. I want to end with asking you a little bit about taxes and pro sports teams. Specifically, we know that sports teams in states with no state income taxes have an advantage over teams based in, say, California or New York when it comes to recruiting talent. Talk about how you're able to use that financial edge to structure your roster in order to produce better performance on the field. Is that something that you think about?
It's a great sales point. Texas is one of the most amazing business markets in the entire world, and Dallas, like I said, is now really a global city. For us, as we recruit soccer players, and we talk about not having a local, state income tax, that's a big deal for players that are looking at the Dallas market versus a market like New York or Los Angeles. Their money goes so much further. Also, we have great school districts, and the housing is so affordable, even though we're in this unbelievable boom time since really COVID. But but your dollar goes so much further in the state of Texas than it does in other markets. And so for us to recruit players recently like Petar Musa, who we signed from Benfica, the Croatian national team player, and to explain to him how much further his money will go in this market, it makes a big difference for us. And if you look at other sports leagues, so many of the players reside in the offseason in Texas, in Florida, in Nevada. We see that from NFL players, NBA players. So it's a definite advantage.
Yeah, we definitely see that in the NHL, where the teams from Canada are definitely at a disadvantage compared to those in the U.S. and certainly compared to those based in places like Florida and Texas and Nevada. Dan, really appreciate your joining us. Dan Hunt of FC Dallas. Meanwhile, Dallas was actually the site recently of another historic World Cup, but this one for cricket. Team USA pulled off one of the biggest upsets in the sport's history after beating Pakistan last week. For more, we're joined now by Sridhar Natarajan. Did you watch the games?
Of course
the
I
matches.
did.
Sorry, matches, right?
Yes, matches.
Can't
4
say
hour
games.
matches, T20s, but of course I watched the game. It's a historic moment in this country. The Cricket World Cup coming to the US, you would never have thought about it, but it's happening now, and with the USA team doing well, not just a historic win last week, they actually qualified today for the next stage. They're one of the final 8 teams in the tournament, so this bandwagon will continue to roll on for a little while longer.
And when it comes to the team, what's fascinating about the team is, the makeup of them and what they are, who they do. Tell us a little bit about that.
Not very different from the 1950 soccer team in the US when they pulled off that historic upset over England. That was a team made up of part-time players, very, very much so with this 2024 USA cricket team. It's a lot of people for whom cricket is a passion, but not their full-time gig. You have a lot of Silicon Valley tech workers, part-time Uber drivers, restaurant workers. They've all come together and formed a team, and clearly, as a team, they're doing well enough to be counted among the very best.
I am curious. It's funny you mentioned the women's soccer, which, of course, a lot of people sort of credit for sort of really elevating just the awareness of the international game of soccer here. And I wonder if what we've seen over the last couple of weeks could do the same for cricket. I mean, there were a lot of folks taken off guard. I was walking around New York City the other weekend, and I had no idea they had this big match between India and Pakistan. But I saw everyone in the shirts and everything else, and I was like, "What's going on?" And I felt left out.
It was a big day. You were left out if you didn't watch the game. But it is true. Let's be real. It's not like just because they've had this World Cup, you will have a sudden massive increase or surge in popularity with the sport. There will be a blip, but then it'll go down again. You need to water the seed, as one of the players told us. The bigger challenge is how do you grow this over the next 20, 30 years? When I talked about the 1950 historic win that the USA team had over England in the Football World Cup and the Soccer World Cup, it didn't immediately take off after that. In 1994, the Soccer World Cup came to the United States. After that, it's taken another 20, 30 years for the sport to have gotten to a standing where you look at it as a serious commercial prospect in this country. It might be faster than that for cricket because, as I like to tell everyone, the scientific definition of cricket is the more interesting version of baseball. So the chances of it becoming more popular more quickly are a little bit higher, Romain.
Oh, boy. All the baseball fans, send your emails to Sri Natarajan over at Bloomberg. He actually has a great story here about that World Cup tournament, Scarlett.
Yeah, very dramatic photos in there, too, as they celebrate their win on that cricket match. Not game, match.
Yeah, match. And were you aware of the one that they had in New York? It was out on Long Island the other weekend.
I wasn't.
And it was a big deal. I mean, between India and Pakistan, and they built this whole temporary stadium out there. And like I said, I was kind of out of the loop. I just saw one.
I'm sure it was on FanDuel and DraftKings and all that as well.
But I mean, it's coming, right? I mean, there's obviously an audience for it, and the matter is whether can sort of broaden.
Absolutely. Disney's sports ambitions rested a lot on its ability to air cricket games, which it lost. I think the India channel lost that. So that's another thing that we're always looking at here. All right. What we also looked at today was the performance of stocks. I mean, come on, we're near record highs, so it's not like we really fell. Yeah. We're just kind of hovering at those levels, although the Russell 2000 definitely fell.
Yeah, I think there was a lot more. I mean, obviously, it's a little meh on the day, but I think when you look at that drop you saw in the Russell, the S&P 400 mid-caps transport, some concern there. But again, if you're a tech investor and you crowded into that space, well, you did pretty well this week.
Yeah, certainly. Yeah. Adobe was a big winner today. Worth mentioning as well, French stocks and French bonds continue to decline. The French stock ETF losing 3 1/3%, and there was some flocking to safe havens like gold. This is the close. summer, Father's Day is here, and with it, the challenge of picking the perfect gift for dad that doesn't involve ties or golf balls. I went to Bloomingdale's iconic New York City flagship store to meet with the executive who directs the department store's merchandising strategy.
There are so many different unique gifts that you can buy this Father's Day. For the barbecue lover in your life, you can get them a great tool set. For the golf lover, we have golf bags and different travel kits. For the fashion obsessed, we have really, really hot trend items. For the one who's going to be by the pool the whole summer, we got great swim assortments. So there's very many different ways that you can go this Father's Day.
So while gifts for your grill master or avid golfer are still in play, the classic polo shirt has met its match.
I think men need to shake it up a little bit every once in a while, too. You kind of see, actually, our hottest item this summer is something that we've not seen before, the short sleeve knit. So every once in a while, you'll get something that's really fun and, like, you know, daring for the male consumer. But
short sleeve knit, how is that different from a polo shirt?
It's a short sleeve button down knit, and it's fully sweater knit. So very, very different than a polo shirt, and with a lot of fashion iteration. So that was like the new hot item for the male consumer this summer. And when a man finds something they love, the thing I love about the male customer is that they'll buy several of them.
And how long will that trend last, at least for men? How long do you expect?
They last a lot longer, which I'm very happy about because it's much easier.
Now, Dad's Day gifts are a must-buy for most consumers, but the ebbs and flows of the overall economy also influence what consumers buy and how much of it.
People are impacted differently by what's going on. But we absolutely do see some people buying less frequently, but really, really spending more and buying those pieces that are going to last for them.
It's a tall order to find the right timeless gift, but there is likely something out there for every type of dad. And the pros are standing by, ready to help. Happy Father's Day. And there's more where that came from. We're going to share more of my conversation with Denise Majid, the chief merchant at Bloomingdale's, in the coming days. Joining us now for a broader conversation on menswear at department stores is Mary Ross-Gilbert. She is Bloomberg Intelligence Senior Equity Research Analyst. Mary, great to speak with you. And of course, what's interesting with what Denise Majid told us is that the way men shop is very different from the way women shop. And clearly that's seen in, the frequency and how often they update their wardrobe and the volume that they buy in. When they find something they like, they buy a lot of it. You've been combing through some data on menswear apparel. What did you find that really stuck out to you?
Yeah, so we looked at a couple of things. One of the things that we also tracked in addition to looking at the composition of menswear. So if you look at department stores, menswear, primarily apparel, comprises anywhere from 15 to 20% of revenues for the department stores. And with regard to how big is Father's Day relative to Mother's Day, so we looked through Bloomberg's second measure and we looked at what happened in 2023. And in 2023, sales for Mother's Day were anywhere from 12 to 25, actually 35% higher. At Dillard's, Mother's Day was 35% higher than Father's Day. For the rest of the retailers, the department stores, it was somewhere, in that sort of 12-ish% range higher on Mother's Day.
Yeah. Well, speaking
just to give you an idea.
Thanks. Well, speaking as a father, I think that's criminal. I am curious. In all seriousness, though, Mary, there's been a lot of discussion over the years about the importance of the male shopper and the idea here that a lot of retailers, they prefer the woman shopper because they feel like she spends more, she makes a lot more of the household decisions, and she spends more frequently here. But we have seen stores, and I could speak at least to the Bloomingdale's, which we have right across the street from Bloomberg World Headquarters here. I mean, they have a really expansive men's section, which I love. And it's separated from everything else, so I don't have to be in the midst of all the perfumes and all the frilly stuff here. So I love that. Are we going to see more retailers do that and understand that we have money too? Men matter.
Absolutely. And actually, if you look at some brands, for example, in the clips that you were showing, Ralph Lauren stood out. And Ralph Lauren, about 65 to 68% of Ralph Lauren's revenues are for menswear. Menswear and accessories, just to be specific. But about 56% of the purchasing is happening by women. And that will happen across the board. This is similar to Levi's. Levi's, it's about that 65% figure. Yeah. And we think it's fairly close to that figure for other denim brands like Wrangler and Lee's Parents, which is Contour brands. Yeah. So they also, skew to the male. And that's why the women's part of the business has been a big growth factor. So yes, menswear is very important for Abercrombie and Fitch. Yeah. If you walk into Abercrombie and Fitch, half the store is menswear, half as women's wear.
Yeah.
So absolutely, you're getting there.
All right. Democratization.
Wow.
Mary, great stuff. Mary Ross-Gilbert over there at Bloomberg Intelligence. And Scarlett, first of all, that's a wonderful package. I couldn't help notice that you spent all this time filming this. So it brings me to my question. What did you get me?
You're not my father. I don't need to get you anything. But, it's interesting that we talk about retailers catering to men. Lululemon has done that, and they've really focused in on providing comfortable office pants for men.
And that was a switch. I remember going into a Lululemon 10, 15 years ago.
And being bored out of your mind?
And the men's section was literally one little hanger of some slacks and stuff. And now you go in there and it's much more expansive. So I think a lot of stores are kind of waking up to the fact that we have money too and we actually shop.
Yeah, and you like being comfortable when you're at the office.
Well, sometimes. Not at the office. I like being on edge at the office. Ooh. Hey, look.
Good job.
It's almost the weekend. Look, the close. We're about to wrap up this show, but don't go anywhere. Before you go, we're going to set you up for what to watch next week. This is Bloomberg. As we close out the week, let's set you up for some potential market-moving events over the next week. And we start off in China.
Yeah, a data dump. And we say that because we've got industrial production, we've got retail sales, we've got the unemployment rate, which they used to track the youth unemployment rate, but that number didn't look too flattering, so they got rid of publishing that.
Oh, that's one move.
Yeah.
All right, back here in the U.S., actually on Capitol Hill, we're going to hear from the Boeing CEO, scheduled to go back on the Capitol Hill to testify some of the issues facing the plane maker.
I feel like this is kind of a familiar thing now, right? There's a mea culpa, there's a promise to do better, and really the big question is, when are they going to have someone in place to really move the company in a new direction?
I think that is the bigger question here, not so much what happened in the past, but how this company is going to move forward in the future. Just a reminder here for all the traders out there, this Wednesday is a holiday here in the U.S. Markets will be closed for Juneteenth.
Yeah, Juneteenth became a public holiday in 2021. So one thing that's happened is that people take off for Juneteenth and they take off all the way through the 4th of July. So maybe we'll see slower trading.
All the way through the 4th of July? Who are these people?
Well, not you and me, but a lot of other people do.
All right, we get some central bank decisions that they're going to miss if they decide to take off. That includes from the BOE as well as the Norges Bank as well.
Yeah, and the SNB as well. So we'll, of course, be covering all of that. There's also earnings, let's not forget, even with this holiday shortened week.
Absolutely. We're also going to get some earnings out of, Darden, some of the home builders as well. KB Home. So earnings never sleeps here, but maybe an interesting read here on consumer spending and the health of the new home sector, at least. And don't forget that S&P end of the quarter rebalancing. That goes into effect basically 1 week from Monday here. I believe CrowdStrike, one of the names going into the S&P 500.
Along with GoDaddy. Remember when GoDaddy was just an advertiser on
Okay, all right.
the random shows that you watch? Yeah,
KKR, I think is going in there. I think that's one I think people are a little more interested in here. Nevertheless, though, we'll have a full breakdown of all the market coverage as we do every day right here on The Close. Thanks for joining us this week. Stick around. This is Bloomberg.